We go. Fellow risk takers, this is your worst. Podcast host Andrew Stotz from Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story on episode 645. Larry's unique because he understands the academic research world as well as the practical world of investing. Today, we're going to discuss chapter 8 from his recent book, Enrich Your Future, The Keys to Successful Investing. And that chapter is titled, Be Careful What You Ask For. Larry, take it away.
Yeah, thanks, and good to be back, Andrew. And this chapter, like almost all the chapters in the book, begins with an analogy to help people understand a difficult concept. And everyone, I think, is pretty much familiar with be careful what you wish for, in the story of King Midas, who was granted a wish because he was a generous host. And the wish was he wanted to be the richest man in the world, so he asked for everything he touched would turn to gold. Unfortunately, he wasn't specific, and everything included food and everything else. And eventually he was so upset, he went to hug his daughter and console himself, and she turned to gold. He was so despondent and pleaded with the gods, who eventually relented and restored his daughter. So here the analogy is to be careful what you wish for in investing, because if the whole premise of active management is the belief that you can forecast what's going to happen better than the market, right? And so a study was done by a fellow named Jim Davis out of Dimensional, and he looked at the hypothesis of what if I could predict in the emerging markets which countries would have the fastest growth rates, and then just invest in them. And you could even go short the ones that would go slower. Now, nobody can predict with that kind of accuracy. And yet the strategy, it turned out that Davis ran the data, and he found that the high growth countries in this period, which was 1990 to 05, returned 16.4%. And the low growth countries, guess what? Returned exactly the same 16.4%. So the lesson in that story is really, it doesn't matter if you can even forecast that these are going to be the great countries, if the market also forecasts that. And in other words, you have to be able to forecast better than the market. So the low growth countries may have turned out to actually do better than expected, and they got the same returns because of that. The high growth countries were still higher growth, but maybe not as high as the market expected. And so they ended up with the same returns there. So that's really an important lesson here. It's that we see the same phenomenon, and we've talked about this, when companies report what look like good earnings. Earnings grow 20% and the stock drops 15%. Why? Because the market expected better. And at the same time, we see earnings down. Tesla just reported their sales were down, and the stock jumped because they weren't down as much. So again, the key is here. You have to be able to forecast better than the market already expects, which means you can forecast surprises, which by definition are unpredictable.
So there's a few things about this. First of all, the concept of forecasting the economy. I mean, it's hard enough to forecast companies and the stock market, but to forecast the economy the premise is a tough one, because also there's such a delay in information compared to companies. So that was the first thing I thought of when I was reading what you wrote. The second thing is, one of our best examples of this is China, where the economy grew at a nominal pace of, let's say, 15% over the last 25 years, but the stock market has basically returned zero on an average annual basis over that time, having gone up massively and crashed massively, up, down, but now down a lot. So China's a great example how there just really isn't this connection between the economy and the market.
Well, and the logic is exactly the same logic that we talked about between thinking about great companies, which are growth companies, which do have higher growth rates of earnings and sales, et cetera, than value companies, which tend to be distressed, but they trade at much lower valuations. And so people think if I can identify the stocks that are going to have the higher growth rates, I can get higher returns. But exactly the same phenomenon played out, and value companies actually have had higher returns in the long term because they're viewed as riskier, the market discounts it. And the only way you could really have outperformed is if the market was thinking some growth stock, call it NVIDIA, would grow earnings 30% and they grew them 100%. So you have to be able to predict much better than the market because you now have to impose your cost of gathering that information, trading as well. So that creates another hurdle. You can't just be smarter than the market. You have to be smarter than the market, sufficient enough to overcome all of your expenses of gathering the information and your trading costs and implementing it. And then, of course, you have to overcome, if you're a fund manager, the expenses you charge your investors.
And also, a prelude to the next chapter where we're going to talk about the money illusion. I went back and did a calculation for my students in my valuation masterclass and looked at it was either the US or OECD countries since post World War II. And the nominal growth rate was about 6% for economy. What can we use that number for? I mean, if we know on a year-to-year basis or on a quarter-to-quarter basis, there's no benefit of correlating that with the market. Is there anything that we could use that number for?
Yeah, well, first of all, you have to make an assumption here about whether that's predictive of the future, which will be dependent upon lots of policies and geopolitical events and et cetera. But what we do know is that over the long term, corporate earnings should grow in line with nominal GNP. If there will be periods when corporate earnings will grow faster, and that's usually in coming out of recessions because workers can't command big wages, labor markets are loose, companies can now start to get productivity increases as volumes go up, and they don't have to raise wages. You get into the latter stages of recovery, like the US is in now, for example, and labor markets are tighter, you now have to pay your the workers more, and they tend to have more bargaining power. So what has happened is corporate profits as a percentage of GNP over the very long term, up until recently, had wandered between about 6 and 10%. And it would get up to about 10%, and then workers would command, more of the share of the GNP, and it would go down and would cycle. What happened since the 2008 period is that corporate profits expanded more, and that showed up with workers having lost real wages. But that can't go on forever, right? So I would expect, if you think, for example, today you're going to get 2% inflation and 2% nominal growth, then that's 4% nominal GDP. Then you should expect corporate earnings to go up 4%, and you should expect stock return.
Just to correct what you said if you expect inflation of 2%, and I think you meant to say real growth of 2%.
Real growth of 2%, not profit. That would get you 4% GNP growth. Yeah.
And you use GNP. Some people use GDP. Is there any particular reason why you're using GDP?
It's same. Okay. Most of the numbers look at GDP.
And so let's now summarize this for just a second. The growth in the economy, let's say, has averaged 6% in the past, and corporate earnings
3% growth for the U.S. and 3% inflation.
Yep. And we know that corporate earnings are much more volatile, sometimes coming in below that, sometimes coming in above that. But if we calculate the cumulative average growth rate and compare the two, they're pretty close. And I haven't done that yet, but that's something that we could do. But I know from my own experience that they're pretty close.
Yeah,
And
exactly.
so then the next question is, when we think about the market and forecasting the market, here's where it gets difficult. I think John Bogle was probably a great one at explaining that when he made his chart where he showed the factors that are driving the market related to the change in earnings, the dividend payout, and the PE factor that would sometimes go super high and sometimes go super low. And I guess that if we could say over the long term, there's a correlation between, or there's corporate earnings and GDP are moving in the same way, then it really is the price factor that just gets so wacky that causes
and that's the unpredictable, because we don't know what the risk premium is going to be. Sometimes people perceive things to be less risky, and sometimes they underestimate risk and you get bubbles. Investors become over enthusiastic, and sometimes you get lots of risk showing up and people get overly pessimistic. They fail to understand that governments will enact policies to hopefully turn things around. In the US, that's always happened. So if you bought in the bottom or even during any recession, that's when you got the best returns. But by the way, that volatility in corporate earnings, which is much more volatile than the GNP, is exactly why there's a big equity risk premium and why stocks have returned more than the 6% nominal growth in the GDP. If the stock earnings were as stable as the GDP, stock prices would be much higher because equities wouldn't be so risky, right? I mean, the GDP, even in the Great Depression, didn't fall 50%, but we've had stocks fall a lot more, right? So that if you had less volatility in corporate earnings, people would view stocks as safer, pay higher multiples, and then the return to stocks, of course, would then be lower.
So one last part that I want to highlight.
Oh, by the way, that's another good one of be careful what you wish for. I wish corporate earnings were much more stable. Stocks would be less risky. Be careful. You might not like that because you won't get a big equity risk premium.
Yeah, that's a great point. And the last part on this, I was thinking about Jeremy Siegel's book, Stocks for the Long Run, which I found useful when I was a young analyst because I didn't really have a lot of that kind of data here in Thailand. But what I was kind of surprised about was that actually emerging markets earnings performance and stock performance actually would underperform because of dilution and corporate governance and things like that. So even though you may map, let's say US earnings growth, corporate earnings growth, when you look at the corporate earnings growth of emerging markets, you may find that dilution prevents that earnings growth from keeping up with the final cumulative growth rate of the economy.
It could. It's absolutely true. That's one of the big reasons China has underperformed. Massive issuance of new stock, right? But what could also be the case is the emerging market investors got told these stories by people like Burton Malkiel, who I have the highest respect for, said you got to invest in these high growth countries. Well, that's like saying you got to invest in high growth companies. But it's the value companies and the value countries that tend to provide over the long term higher returns because they're riskier. So people got over enthusiastic, bid up Chinese stock prices, other emerging markets often. You had bubbles and they eventually burst. The price you pay matters. It's not just economic growth.
Yeah, that's a great discussion, and that helps set the stage for the next chapter we're going to cover in the next section, which is the Fed model and the money illusion. Larry, I want to thank you again for another great discussion, and I'm looking forward to that next chapter. And for listeners out there who want to keep up with all that Larry's doing, follow him on Twitter at Larry Swedroe, and also, of course, on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.